Mortgage Smart tips for first-time homebuyers. Mortgage terms. Buying your first home can be a daunting process, including figuring out the right mortgage and options for you. One part of this is knowing about what mortgage term to select. Here, let's talk about its definition and what it really means. The options available and how you choose the right one for you. The definition of term is the number of years or months over which you agree to pay a specified interest rate, and the lender commits to not changing it or asking for their money back, except in default, of course. Also refers to whether it is an open or closed term. Options for terms can be any of the following. Lengths are 6 months, 1 to 10 years, up to 25 years for secured lines of credit, although fully open. A term that renews on a specific date that the lender sets in the future, for example, could result in a 2-year, 6-month term. A term can be open or closed. Completely open, so even though a length of term is stipulated, you can pay it back in full with no penalty, or completely closed, so a penalty is payable by you if you repay early. So how do you select the right one for you? Determine which terms you actually qualify for and can select from. You may be limited to a 5-year fixed term based on recent legislation changes. If you want a 1 to 4-year term or a variable, you typically have to qualify at a much higher interest rate known as the benchmark rate. This might reduce the amount you qualify for. I can let you know your options. Consider selecting your term based on the current trend for interest rates going up or down. For example, you might select a 5-year fixed term because rates are starting to go up and you want to lock in that lower rate. You might select a shorter term if rates are expected to remain low and aren't expected to rise. Consider selecting your term based on any expected changes in your income. Fixed term at the same rate and payment for the next 5 years makes more sense and better suits your needs now. Consider how long you intend to stay in this home, a question we asked earlier. You might want to align the term with your future moving plans or even possible job relocation opportunities. You may be expecting to receive a large sum of money soon and want to pay your mortgage off in full or large part. Paying in full before the term expires may result in a penalty if the term is closed. For example, selecting a 2-year term, which is when you plan to pay it off in full, will save you money in penalty costs. If you have any questions, give me a call and subscribe to my channel for more helpful tips on selecting the right mortgage for you.